Nervous about the volatility of public markets? Looking to invest in Canadian real estate but not finding the right opportunities? Neighborhood Holdings may be an option. Nearly 10 years of consistent performance, Neighborhood aims to provide stable income while preserving invested capital, target net yield above 8%. At the heart of the strategy is Neighborhood's mortgage product portfolio of first position 100% residential mortgages across Canada with an average loan to value under 55%. Neighborhood partners with mortgage brokers and financial institutions who support quality borrowers in transition who may not currently qualify for traditional financing and have a temporary need for capital. Neighborhood's portfolio has no exposure to commercial, construction, or bare land properties, is geographically diversified across major urban and suburban centers in Canada. Check out the links in the description or visit neighborhoodholdings.com to view the offering memorandum for investors and advisors or to explore mortgage broker partnership opportunities. This is not advice. Please consult a professional advisor before investing a loonie in any of these investments. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 202. As always, join me the three amigos. We got the Boomer over in Halifax. Rich Diaz, you're still stuck in Portugal?
I am still stuck in Portugal. I'm stranded, and I'm not too pleased about it either. I'm very much ready to go home, and it was an absolute shit show to get a ticket. At first, they offered me so I was supposed to leave on the 18th. At first, they offered me a ticket.
You were supposed to fly back on Air Canada?
Yeah, I was supposed to fly back on Air Canada. First, they offered me a ticket on the 29th, and I was like, you've got to be kidding. And then I waited on hold for 3 hours, and I actually did a little hack. I went through the Portuguese Air Canada, so at first I waited on 3 hours, didn't work. Then I went through the Portuguese Air Canada, only had to wait 45 minutes.
Wait, you can speak Portuguese?
I can speak Portuguese pretty well.
Jeez, I didn't know that.
And so after that, so now I'm leaving on Monday. But I just feel
say
really...
Loonie Hour rocks in Portuguese.
No, I can't. I can't. You can't put me on the spot like that.
I think he's full of it.
Come on, say something. Say something in Portuguese.
Do something.
Muito obrigado por toda a gente ouvir a Loonie Hour cada semana. A gente somos muito felizes de ter você, nossos fãs. There you go.
Sounds made up to me. I don't know.
Do it again, but with more emotion this time, Rich. Lean into it. Like you're a little bit coming back.
No, I'm way too embarrassed to do that now.
So when are you coming back?
So coming back on Monday, but I just want to say, I feel really, really bad. First of all, it was a total, there's not enough being made of the fact that basically there was no real negotiation and they were just relying on the government to pressure people back to work. But I just want to say, I'm in an amazing situation. I'm living with my aunt and uncle. Don't really have to worry about a hotel or food or car or anything. It's been very chilled. But imagine imagine that was your one holiday a year. You had to get back for school. It is insane that they left it, that people, hundreds of thousands or 100,000 people were stranded. I think, and it's now no longer a thing on CBC. It's just it just disappeared from the headlines. People should be outraged about what has happened. Again, for me, it doesn't really affect me that much, but it was crazy. And so, yeah, I'm stuck here.
Next week, we'll be interviewing the CEO of Air Canada and Cupid.
Anyways, it's funny how how long things last and in the news and the zeitgeist or whatever. But anyway, I'm here and I'm ready to talk about.
Is it
lots
Cupid
of good
or
stuff.
Coop?
I think
Cupid.
it's Coopy. Any hoozle.
Coop.
Keith, what's going on, buddy?
It's Boomer is in the last days of summer. We had a real nice summer, all in all, but we're pretty excited.
The pool.
Yeah, join the pool, but or the club. It's not just a pool, Steve. It's a very nice club.
Miss Icecap said you're a bad swimmer.
I'm pretty good at the can opener. I can tell you that. Do you know
hell
what
is
the
a
can opener is,
cannonball?
Rich?
Yeah, of course. When you jump off when you try to splash people.
Well, you jump in, but you hold one knee up and it goes in. Anyway, I think now we're at the 5-minute mark. Line us up, Steve. What do we got going today?
All right. Okay, everyone, fast forward here. National house prices. We're gonna get through some of that. We got Canada's CPI inflation. We got a whole chorus of central banks coming up in September. So we're gonna kind of go over what that looks like. We got some foreign capital flows, updates across the country, as well as what's happening in Canada's rental housing market and the mortgage renewal wall, which has been talked about for the last couple of years. We had an update from the BOC with some good data on that. So we'll kind of walk everybody through that. But Rich, I guess we can start it off on the housing front. We had last week the national housing. So the national housing data in Canada comes out on the 15th of every month. So last Friday, that data came out, effectively showing what we've been kind of reporting on here on the Loonie Hour, which is like home sales are bouncing, and they're bouncing because home prices are finally kind of coming down, enticing buyers to get back into the market. But we are seeing seasonally adjusted home sales. I think we're up for the last 4 consecutive months, which is relatively unusual considering you get into the summer months and things tend to slow down. So we're seeing that uptick in housing activity. People are, I guess, wading back into the pool, so to speak. But what you can see is national house prices, the home price index as it's measured is down 18.5% since the peak. That is, so the home price index was created back, I believe, in 2005. So, I mean, it's got a 20-year track record now. So 18.5% is by far and away the steepest price decline ever measured by the National House Price Index. So if you go
Steve,
back
what's
to
the
like
source? Sorry
that?
to interrupt you. What's the source?
So CREA, Canadian Real Estate Association, they have their effectively they aggregate national house prices and put it in like a hedonically adjusted price metric. It'd be like similar to like the US's Case-Shiller home price index. So that's down 18.5%. I think during the GFC, Canada's home price index declined nationally about 9%. So we're basically double the GFC, at least in Canada.
And that housing is affordable now. sorry.
Yeah. But the GFC decline was very rapid. You know, it was like like the arse fell out of her, you know. This one here is there she was gone. But this one though, Steve, this is like a continual gradual deterioration, correct?
Yeah, it's kind of been just like it's almost like a slow bleed lower. I feel like it's accelerated obviously in the last like 6 months with like the whole tariff stuff, but it's kind of been like a slow bleed. It kind of had like a little bounce, I feel like last year, and it's kind of been leaking lower ever since. So,
but if it's a wound, like if it's like a slow bleed, eventually, you know, you have massive head wound. Harry is there. Do you remember him?
No idea what you're talking about.
I think that's a Saturday Night Live guy. Back when that show used to be funny. He's not funny anymore.
It's had a good couple of years, actually, to be fair.
But the point is that we get this continued deterioration, and then we're able to look at other data points that's also maybe they're deteriorating or an offset. That's why it's just so interesting today. I don't think we've seen a turning point in any of these trends yet, have we?
I don't think so. No, but I mean, I think the seasonal activity increase in home sales. I think Toronto from the lows is up like 30+%. So again, I think just I think what you're seeing is basically like, to summarize it in like sort of simple terms, is I feel like the market was just completely illiquid for like the 3 months after the tariff shock. I think that tariff shock is wearing off, at least from like a news headline perspective. People are sort of adjusting and trying to move on with their lives. And I think they're now sort of slowly dipping their toes back into the housing market. And because prices have come down during that time, I think it's a lot more attractive. I think that we're just seeing an increase. Like, people have to get on with their lives. Like, what I'm seeing is basically like, if you got, you know, a move up buyer, let's say they got a condo and they want to go to a house, you know, if you got a kid, you got a second kid on the way, like life, you can't delay your life for the next 2 or 3 years waiting for like the market conditions to change. And so what they're seeing is just saying, listen, I made an offer on the house. I got the house for a lot less than it used to be. I'm going to give up money on the table for my condo. And, you know, it's like everybody just takes less to facilitate the transaction. I think that's what we're seeing.
I have a question though. Can you be more specific? Like you mentioned in the past that series is dominated by Toronto and to a lesser degree Vancouver. Are the price declines sort of across the board? Like what's going on in Red Deer?
Yeah, I mean, Red Deer. Rick from Red Deer wants to know. It's predominantly in the GTA, Vancouver, suburbs, Fraser Valley. We're seeing Alberta markets. I think Calgary in particular now is starting to show price declines. Those are kind of like the three. Yeah.
Oh, okay.
I mean, they had the thing, and I've told people this so many times, right? It's like Calgary has the ability to build very, very quickly. The free market, the private sector in Alberta is free. There's lots of land. The permitting process is very quick. It's very cheap. There's not all this like development fee garbage that you deal with in Vancouver and Toronto. And so when house prices get hot and when they're moving up, that private sector moves very quickly to build new housing, and they always end up oversupplying the market, and that sows the seeds for sort of the correction, which Calgary is clearly going through right now.
Sounds like they need more government involvement for the planned economy. We could smooth out all of these, these valleys.
Do you look at the Terranet National Bank data? Is that something you look at?
Nah, Terranet's, I mean, it's good data. It's just lags like crazy. So they do like paired sales. So they'll look at like, okay, you bought this house 3 years ago and it just resold. So they'll basically say, okay, well, what's the price change? And then they'll do their like calculations, right? But it's like it's just a lagging indicator. And honestly, so is the home price index. Like that data by nature, I don't think shows the true magnitude of the correction. I think it's in many markets, it's steeper than 18.5%, right? I mean, if you go to the GTA suburbs, you're down 30%.
Okay. That leads me to my next question, which is what's the difference between like the condos, which we're going to talk about? Good segue there from me. And the single family homes. Like obviously the single family homes aren't collapsing as much as the condo prices, right?
They're coming off, but I mean, like, like a $2 million house comes, when a $2 million house gaps down, it goes from 2 to 1.8, right? When like a condo that's 700,000, it goes down to like 625. Okay. So like that's why it actually makes sense in a lot of cases for those move up buyers if you can move up, because like the higher price points come down more,
right,
relative to like your entry level product, for example, right? So, but I think like the big story out of all this, again, I wanted to touch on the mortgage renewal wall, but I also want to chat on what's happening in the housing starts side. What we're seeing, and we've talked about this on the show quite a bit, is you're seeing pre-sale condos collapsing. So it's funny. There was actually an article in Maclean's, the old front page news cover, which is kind of a contrarian indicator. But it basically says Maclean's, and it's like it's this Jenga tower that is like collapsing, and it says the great condo crash. After years of frenzied building, buying, and flipping, the market finally toppled. Why Canada's biggest cities are flooded with tiny units no one wants. So I don't want to call a bottom here, but that is the
wow, that's the biggest fattest bottom we've called. So Steve, you heard it here first. Steve is calling a bottom in the Toronto condo market.
Yeah, that'll be someone's gonna clip that and that'll start circulating. No, but from a sentiment standpoint, it kind of tells you where we are, right? I mean, anytime something makes front page news articles, usually a good sentiment indicator to move in the opposite direction. But
I think that it also shows, we've been talking about it now for a while. And, I think, you guys both mentioned sometimes we're early maybe with a concept or a trend. And now I just think now it's nationally, it is catching up. So you had the Maclean's magazine, of course, doing it. But let's sort of move around to in the same market, in the real estate world in Canada. Has anything else happening that supports the continued deterioration of the market, Steve? Or have you seen anything that says, hey, you know what, maybe, this isn't the bottom, of course, exactly on this day, but maybe, there must be some positive developments in the housing world?
Yeah, I mean, I think it's positive depending on what side of the coin you're on or what side of the balance sheet that you're on. Effectively, what we're seeing is like, again, you've seen this deterioration in pre-sales. You got 30-year lows in new construction homes in GTA, like in Greater Vancouver. I think like for the first 2 quarters, we've had like 1,000 pre-sale units sold compared to like 6,000 and back in 2021, 22. So you've seen this huge drop off in pre-construction sales. And so what you're seeing is all these developers now that still need to sort of keep the lights on. They need to keep their employees actively doing something at work. So a lot of them are just continuing to pivot and trying to go rental. And the biggest sort of flag I would sort of signal to everybody is like, I think there's a real crisis brewing in the rental market. Friend of the show, Ben Rabideau, has chatted about this a lot. He had a great chart circulating on Twitter this week, basically showing the increase in rental construction. So if you take purpose-built rentals and then assume half the pre-sale condos are going to go rental, you got about 250,000 units under construction. It's just like all-time highs. And we're already seeing, Rich, we're seeing rents are declining across the country. They're down 10% at least in the GTA, 10% in Vancouver. Now Calgary's down about 10%. So like those are three major markets there. There's just so much rental product coming to market. And in a market where rents are already declining, and you got record units currently under construction that will be completing over the next 24 months, combine that with zero population growth. And I'm like, well, logically, one would conclude that rents should fall further, vacancies should rise further, which is great for sort of like the long-term health of the rental market, which we desperately needed. But at the same time, it's like, Keith, on the other side of that balance sheet, someone's eating that.
Well, we have this sophisticated model at IceCap, and it's when demand is less than supply, price goes down.
Wait, let me write this down.
Yeah, you got that one, Rich. But jokes aside, again, I'm seeing it here locally in Halifax. Rents are coming down. It is, and then I look at the supply that's coming on market within the next, I guess, 6 months to 18 months, 24 months. It's enormous. So you're going to have so many more units or beds or rooms, whatever you want to call it, here in this city. And is population still growing down here? It can't be growing as much as what it was for the previous 2 or 3 years. So I guess the silver lining for this on the optimistic side or the positive side, for the consumer, they'll have to allocate less of their budget for housing coming up, which means someone else, as you said, Steve, they have to eat that on the other side. Because when they first started these builds, I mean, they're using their estimates of what their return is going to be on the capital that they're putting and so forth. And now they have to change a few numbers.
So here's what's happening. This is where I'm like, this is interesting. I know we have some policymakers that listen to the show. So this is where I would sort of start putting out the red flag. Is the part of the reason for all the rental construction is not just because the pre-sale market has collapsed. It's also because we have very favorable government financing that has encouraged rental construction, which again, you would argue, well, that's probably a good thing, right? But like sometimes you can have too much of a good thing. And what I would say, what we're seeing is we are now at a stage where CMHC is financing or has rubber stamped the guarantee of 90% of all rental housing under construction in this country. So 90% of all rental construction that's currently being built, CMHC has guaranteed the loans. Okay. So the challenge now is with that CMHC program is it's a highly levered program. It allows these developers to basically get 50-year amortization and build and find at completion as well. They do takeout financing, 95% loan to value, 95% loan to value. And so what you typically will see is, and they do this prior to. So basically what I'm saying is, when you're going for your construction financing, they do the construction financing at the same time as sort of like the equity takeout effectively. And so what they'll do is they'll basically, you'll see a lot of these developers, they'll kind of juice their budget a little bit. So at the end of the project, effectively, when you go to get your takeout, these buildings are effectively being financed in many cases, not all cases, but in many cases are being financed 100%. So the developers are effectively pulling out all their equity. And a lot, and so the challenge, and then also they've been sort of pro forma in their pro formas, they've got projected for higher rents. They're like, well, today the rents are $2,000 a unit, but like when we're done, they should be 2,100. And again, what we're seeing now is they're not 2,000; they're actually declining to 1,850. And so the problem is going to be on completion when they go to get the financing. They're going to have to come up with massive equity injections. And
I have a question.
We'll see how much cash is floating around.
Just a really quick question. We've talked about the dog crate condos in Toronto and how that's really where they're bearing the brunt of the declines in price. But do you know the distribution of these rentals? Like, is it just dog crate rentals?
No,
or
it depends on the city. Depends on the city.
Okay,
so
fine.
like Vancouver, Toronto is obviously mostly like most of it is fine. A lot of it is like we'll see 6-story wood frame condos.
Oh, okay. So it's not, sorry, when I think rental units, I think like towers.
There's definitely towers that are being built with that program, but a lot of it, at least in Vancouver, is like 6-story wood frame.
So for families. So for families. Not
debatable.
Okay. We're just
so in my neighborhood, it is a wood framed unit that's going up.
So if you go the
NIMBY, remember Steve?
If you go to Calgary and Edmonton, most of that most of them are like stacked townhouses.
Okay.
That's a really popular product there. But like I said, a lot of these guys are basically, it's like that old adage with leverage, right? Like it cuts both ways. And like that leverage looks awesome when it's cheap and when rents are increasing. But when rents start declining the other way and you've got multiple projects that you finance effectively at 100% LTV, and even on a 50-year AM, it basically barely cash flows.
You know what will solve all of our problems? If we just lower interest rates to 0 and leave them there forever and ever and ever.
Now we're talking,
but
baby.
The challenge with all this though, it's two. One, it's linear thinking. Mm-hmm. I've yet to see any forecast anywhere with, that goes out multiple years where it has any kind of cyclicality attached to it. Remember this big push by policymakers over the last year and a half or 2 years is we need more housing. It's a housing crisis. Yeah. It's a housing crisis. And, as we said before, it's never been a housing crisis. And, people get very angry when I say that. It was a population growth crisis. And now that we've supposedly have resolved the population growth crisis, now all of a sudden housing, it may not be a crisis after all because of all this supply that's coming on.
I mean, I would argue both.
So it's my view. The housing crisis was that housing was the symptom of the population growth. So what's happening to population growth now, Rich? Is it?
I mean,
I agree. I would chime in there to say it's probably, Keith, it's probably a combo of like excess population growth, which is ridiculous, and excess credit growth, right? I mean, giving out mortgages for 1.5% obviously supercharged demand.
It's also a philosophy. If you tell people for 25 years that house prices always go up, they start. You can train a population, and instead of investing in machinery and equipment and building new businesses and blah blah blah, people just say the only way that you can get wealthy in this country is by owning homes, and that has been an excellent strategy. So can you hardly blame them? So I don't think it's just population growth. I've been on the front end of that for a long time. But I think it's also, I mean, Keith, before Justin Trudeau promised that he would make housing affordable in September of 2015, house price to income ratios in Toronto and Vancouver were already nuts, right? So, this is I think it's a multi-factor problem, and it's also a long-standing issue.
But we'll just mark it down as you guys are both wrong because it was a population disaster, which created a healthcare crisis, an education crisis.
No, wait. Don't start to conflate lots of different things. I'm just saying housing was expensive before all this fiasco happened, which is what makes it even more insane. And ironically, what we haven't heard a lot about is this, this rental explosion is going to really help working class people, because working class people.
So looking forward, I think Steve, you suggested maybe 2 years when all the supply comes on, right? I think that's what you said
Mhm.
earlier.
Yeah, well, I think it's completing now and over the next, like, we completions are already running really high and they're going to continue to run high. So like, again, you're going to be in a well supplied market for the next several years at a minimum.
Yeah, it's going to be outstanding. And I think, though, we've also established that the condo market is probably going to dry up within, like, two of them should be colliding, shouldn't they? With the rental market, with supply will be increasing, and the condo market will be drying up at the same time. Am I right with
Yeah.
that?
So, and see, just so you know, CMHC, I think is starting to have that oh shit moment. Like, oh man, like this is a good program, but we got way too much exposure here. So basically, over the years, they charge a premium. Like, so they have like effectively they charge like an insurance premium for the rental financing program. So those premiums when the program was launched in the spring of 2022 was about 1.25%. That premium has recently been increasing and increasing, and it's now up to it should reach about 5.7%. I think later this year. I don't know the exact timing on that, but effectively it's quadrupled. So you can see that they're trying to sort of curtail their exposure to the market, but I think it's a real problem, and I think policymakers are going to have some tough decisions moving
So what's
forward.
the end game here, just like going forward? So let's just say in a hypothetical scenario, we get no population growth for the next year or 2 years or whatever. A rental, all the rentals come to market, all these condos get, completed, they come to market, and house prices fall another 20%. Like how much, I know this is sort of a very difficult hypothetical, but how much is like the CMHC on the hook for? Like who ultimately pays the piper? Like who's holding the
So right
bag?
now, CMHC has been it's a profitable organization that effectively, to my understanding, remits revenues back to the government of Canada. So, um, is it possible that that becomes a losing entity over the next several? Maybe, I don't know. I don't know I don't know all the challenges there, but I think high level for our listeners, if they're trying to understand what this means, I think it means we're going to be in a very well supplied market for the next couple of years. Rents should be flat to down probably in most markets. And I think what it ultimately means is there's just going to be more challenges in the development space. Like pre-sales are toast, right? Those aren't coming back anytime soon. And now all the rentals coming to market, it's going to result in a lot of developers having to come up with excess liquidity, excess equity to inject into these deals on completion because they're not financeable at these lower rates. And so I think that's the big story. And that's where I come back to the whole thing was every government saying, oh, we're going to build 500,000 homes. And CMHC puts out these reports saying we need to build whatever it is, 3 million homes by 2030 to get to affordability. But if you look at that wording of CMHC's document, it says if we build the 3 million homes or whatever it was, or 5 million homes, I can't remember the number, that if we build all of these homes, it should bring us affordability, and that would effectively result in like 20 or 30% lower prices. And I was like, guys, if you have 20 or 30% lower prices, not only do you wipe out all the developers, but you're going to wipe out yourself. See, like, I mean, I don't know if that's a great business model. I mean, you guys have got 90%.
Well, the first thing policymakers do in the morning, look in the mirror and they have it on a big sticker says, do not wipe out yourself. That's the. But I think it's actually very clear what's going to happen. If we make the assumption that they hold true on they're going to slow population growth, we have that happening.
Mhm.
The only way, and this is the only way this can work out. It's not like 5 or 6 things moving around at the same time. The Canadian economy has to grow. If the Canadian economy doesn't grow, or it grows with a negative number, which is, that's an economic term, of course. But if that happens, then we get these enormous losses taking place. It's incredibly easy to see this. And then the challenge, CMHC, they've always been remitting to government. Yeah, no, yeah, of course they have. Because we haven't had a major recession for a long time. Rates are always lower, all these things that we just talked about. So, I mean, the government in Ottawa, they know this. I mean, I would hope they see this. They know that the only way out is to grow the economy. So what are they going to do this fall? Bueller,
Spend.
Bueller.
They're gonna
Yeah, they're
spend
going to
money.
spend, baby, spend. And, they're going to hope that works to grow the economy. Again,
Well, that's why
this is the only way it can go for them.
this is where I come back to, because like I just think like the writing is on the wall for the housing market. I mean, it's in dire straits, particularly like I said on the development side, which is like a huge chunk of like all the growth that we've been milking for the last, call it 5, 6, 7 years. And so it's like Rich, it's like, well, where are you going to derive growth moving forward? Because it ain't going to be from housing.
I have an idea.
Let's remove the emission caps and then we can grow.
Of course, we have like the largest. I mean, we have so many natural resources, lots of engineers. I mean, I know this is going to hurt you, Steve. So please, take this. I do love you, but it's okay that our economy is not run by and for the real estate sector. There are other things that we can do and produce that can contribute to society and the world. And I think this is very healthy. I mean, people are not going to like that, but rents falling for working class people, that's good. People learning that you cannot rely on house price increases to generate wealth for your family and yourself, that's good. The fact that interest rates falling will not save us from this problem, that's also good. I see this as all good. I think there's going to be people who are going to hurt, companies, private equity, REITs, all that stuff's going to probably take it on the chin. I think that's a good cleansing of what has been a ridiculous bubble for years.
Yeah, so now we have this simple or simplicity point number 2. Number 1 was they have to run an insane super bazooka deficit, grow the economy. The next part of it is, what do they spend that money on? And it can't be these fluffy things that they like to do these days. It's what Rich suggested.
It's going to be infrastructure.
Yeah, absolutely.
Of almost any
stuff. And none of it is. Yeah, in the energy sector especially, people need energy. Sell it outside of Canada. That's how we can cushion this blow. So we'll see if they can do it with execution. I just think that the speed at which they're going to be able to get this accomplished or even attempt it is going to be very slow. And I just think global factors are going to interfere with any success in this.
So it's just like the thing on it won't be enough. Like this is I think the problem. I follow Mark Carney on Twitter because I guess I'm a masochist. But he often there's tweeting a lot about, we're doing projects with this province, we're doing projects with that province, and that's all well and good. And I I applaud him for that, for changing sort of the language, which is part of his job as prime minister, to change the language, change the narrative, orient our country in that direction. Fine. But the numbers just don't stack up, and that's fundamentally the issue that I think is they haven't wrapped their heads around. And what we look at as capex, I talk about this a lot, gross fixed capital formation. If you want to be a nerd about it, there's private sector and there's public sector. In the public sector, this includes everything from construction, machinery, research and development. You build hospitals, you build railways, you build schools, whatever it is. And then there's the private sector, and we obviously know what the private sector, much of the same thing, except with private capital, et cetera. And the problem is that, in real terms, in 2017 prices, the public sector is about $100 billion on the nose. And it's back to an all-time high. The last high was in 2010. And the private sector is 400 billion, basically, 326. All right, just say 4 to 1. So it doesn't matter, like in a way, it doesn't actually matter what the government does ultimately for growth. You might get a year or a quarter or whatever, Keith, but if you don't get the private sector, which has been flat for 10 years, I've showed this chart many, many times on Twitter, private sector capex used to go up and it has been flat for 10 or almost 11, 12 years now. If you don't get that number to go up, you might get one-off positive growth from government, but you need.
So what's interesting with that is because, the private sector, 3 of us from private sector, we don't like to lose money. That's just the way it works. Governments, ambivalent. In general, they don't care. You can explain it, well, it's an investment in the color green or something. Rich, I think you or Steve had a very good data point earlier. I think maybe it was an article for one of
on
the
National
medias.
Bank.
Yeah, I mean, I think that ties into here. The one about the
Yeah, it
capital
does.
flows.
Yeah.
Do you want to go through that, Steve or Rich?
Yes, well, I can tee it up for Rich, but basically it was a good analysis from National Bank, basically showing that foreign investors have gone MIA in Canada. So from January through June, there's been a net divestment in the first half of 2025. So foreign investors bought 6.9 billion in Canadian bonds in June, down from 9.7 billion in May. There's a $1.3 billion reduction in foreign holdings of federal government bonds, and they dumped equities. Foreign investors reduced their exposure of Canadian shares by 3 billion in June, following a divestment of 11.5 billion in May. Ironically, Rich, we're actually seeing Canadians acquired 9 billion in foreign securities, most of it in U.S. stocks and non-U.S. bonds. So it resulted in an $8.3 billion outflow from the Canadian economy in the month and brought the total exit for the second quarter to 43.7 billion as per StatsCan.
Yes, I mean, so right away people say, "Oh, it's because of the tariffs." It's because of the tariffs. I mean, I to be clear, this has been happening for, again, 10 years, 11 years, where you have had a net direct investment outflow. And so what that means is you just add up how much you're buying of foreign assets, you add up how much foreigners are buying of your domestic assets, you get those two together, and then you see which direction one's going up. And for a long time, they were basically in balance. Canadian investors bought just as many foreign assets as domestic investors bought of our assets. Whatever, you know what I mean. And then obviously, and then you had, and then that divergence kicked off in around 2015, 2016. Make that of what you will. And so that's the number one thing. And the other thing is, I think what's really important to note is that, like, again, unless you get a change in philosophy about how our government treats capital, it doesn't matter that the government increases its 100 to 110. Because if you're the private sector, you're 4 times larger. So that's what I'm trying to get at. I think it's all sort of related, Keith. And anyway, if you want to jump in there, but it's
a mentality,
right? You need to facilitate people, not the government, in thinking that Canada is a good place to invest. And why is that important? Because it improves productivity, which improves the tax base for you know what I mean? Like that's what pays for everything, you know? And so it's very important that we get our heads wrapped around that.
Maybe we could show one of those charts. I forget which
Yeah.
one it is, Steve, but I think it's the one with the red bar on the bottom.
Yeah.
So for the first time, let's put that up on the screen. Yeah, so this is a theme we've been talking about now for quite some time. You know, every country in the world, you want to attract foreign investment. If the money comes in, it's awesome because the productivity from private capital is usually greater than public capital, which Rich is demonstrating, as well as the size of it as well. And this is going in the wrong direction. That's
Keith,
what it is.
It was only a year ago when it wasn't even a proposal. I mean, Chrystia Freeland, as finance minister, had proposed higher capital gains rates. Thankfully was reversed under Carney when he came in. I mean, I think he was almost forced to reverse it, but I mean, like, that was the whole mindset of the previous government. And I think it's just, it's obviously hard to get out of that mindset. And how do you change, like, the culture? And
same players on the ice, I think, right?
Yeah, I mean,
the same team. It's the same team, different coach. I mean,
but if you're trying to tax capital gains, or maybe I know they've also bantered around the concept of, forcing retirement money has to be in Canada and so forth. Now that's really an indirect form of capital controls. That's even a worse thing to do. If you want to attract foreign investors, the last thing you want to do is tell them, yeah, it's kind of a Hotel California up here. You don't want that. A foreign investor wants to know they can put their money in, they can invest the way they want to make money, and then they have liquidity to get out when they're finished. And that's what the cycle goes with. Again, we need some, abrupt moves coming up.
It's funny.
But Keith, the joke. Sorry, one second. The joke is that that's totally part of it. But when you look at the chart, and again, if you follow me on Twitter, you'll see I put it all the time. it's domestic investors that they see the writings on the wall and they're leaving. Like, let's just, before we worry about foreigners, let's just convince Canadians that this is a good place to invest. So anyway,
I think it's a good time to announce that IceCap has set up an office in Portugal. That's why Rich is there right now.
Yeah.
You're right though. You're absolutely right, Rich, and Steve. It's a great points we're all making here.
I was just like an interesting example. I was at the gym this week, and he was like working out next to this guy, and he doesn't know the Loonie Hour. I don't really know that much about him. I don't really know his politics or his ideology, and I just know because him and I have chatted like loosely before, and he's an engineer and he works on these like large infrastructure projects. So I was like, oh, like what are you working on these days? And he's like, oh, I got a couple energy projects, like and he's listing a couple of them off, and they're all like in the United States. And I'm like, oh, like it's like nothing local, like nothing in BC here or in Canada. He's like, oh man, he's like, don't even get me started. He's like, it's just like it's just interesting, like from that engineer's perspective and from their company, that like this is a Canadian living in Vancouver that's like busy working on all these US energy projects because effectively like we just don't build anything in Canada because it's become so villainized and demonized that it's I don't know.
That's why we do have to. I mean, again, I know one listener in particular who's going to text me as soon as I say this out loud. That's why it is a good thing that we, at the margin, seem to be moving in the direction of building something. But if you don't get the private sector involved, it's all talk. It's all talk. And so far, there's been zero meetings with, I don't know, anybody. The Desmarais family, or the other big conglomerate like the Thompson family, though these big families that ostensibly could fund these private sector projects, and there's been none of that talk. There's been no talk with we just haven't seen it. I haven't seen even a photo op, one of those bullshit photo ops where everybody's like, shaking hands and with the giant scissors. I mean, we haven't seen any of it. So I don't know.
Okay, so that means then the one great hope of reviving everything is coming up on September the 3rd. So let me move over to that stuff. Well, if we're not, by that we're talking about the Bank of Canada, of course.
Oh, I was gonna say, Rich, it's it's illegal to talk about energy in this country.
Oh yeah. Oh shit.
Literally. Another good example, though, hey, for foreign investment.
Yeah, Keith.
Yeah. So why don't we do CPI stuff next for Canada, and then jump into central bank stuff that's happening?
Yeah. We'll shift gears here.
Josh, should I just rip through it then?
Well, Dougie. Well, yeah, I'll tee you up. Dougie Ford's gonna like this. Inflation in Canada came in softer than expected. Rich, headline inflation fell to 1.7% in July. A lot of that, ironically, due to gasoline prices, which fell 16% in July, following a 13% decline in June, and is ultimately a reflection of, this is what Stats Canada said, continued to reflect the removal of the consumer carbon levy.
That's a direct quote. What's wild to me, before we go down this, but what's wild to
me, why don't we repeat that again just for emphasis? Go again, Steve. What was that last line?
From Stats Canada. Gasoline prices continue to fall year over year. Gasoline prices continue to reflect the removal of the consumer carbon levy, falling 16% in July and following a 13.4% decline in June.
Yeah. So let's assume that StatsCan is an independent and impartial agency. Okay. I think it's a fair assumption. Like, there are people who are still dying on this hill that carbon tax was not inflationary. And this is what, the fourth of the last 6 months or whatever, that StatsCan has literally a chart 3.
The Bank of Canada did too, by the way.
It's like, what? Who are you fighting? Like, anyways, sorry, I just thought
you're all crackpots, guys. Like, stop it with that stuff.
Never forget when those 200 economists wrote that paper 4 months ago.
It's just like, I doubt that StatsCan wants to get involved in all this bullshit. So for them to put that on page 3 or whatever repeatedly, I might add, with the chart, it's like, come on. Anyway, so all right, so whatever. So
let's dive in a little bit deeper though, because the market reaction, when you first look at the headline number, I mean, the CPI print was a little soft, dovish in a way, which suggests that the Bank of Canada, they now have cover to cut rates.
And what's interesting is that so I looked at the interest rate probability, the OIS curve. We talked about this as overnight index swap curve. You can bet on the outcomes of different interest rate movements. So I looked at the probability before and then right after the CPI came out. And before it was a 69 point whatever percent of no probability of no cut. And then right after it was down to 60. And it's actually ironically starting to creep back higher. But it's just interesting to tell you sort of the market reactions telling you what the headline inflation report was suggesting, which is that inflation was soft. However, one of the charts that they show is CPI excluding gas prices, and we can see that it's basically been flat for the last 6 months. The other thing is, again, you look at things like rent for the rental component of the shelter. Steve, you'll be happy.
Outrageous.
It actually went up. So let's park.
We just talked about this.
I know, but rent is an important part of the shelter component. Shelter component is 38% of core. And so that ticked higher. Let's park that for a second. What I thought was the two things I thought were really interesting was, number one, how the mortgage interest rate component is basically started to completely bleed out. That's sort of just a mathematical inevitability. And then the stuff that we think the thing that I know that the Bank of Canada cares about, because they literally call it the BOC's 3 preferred measures of core inflation. They really should have thought of a better name if they wanted to occasionally ignore that. But yeah, so those 3 are now, so the factor model, which I forget what it is, the weighted median and the trimmed mean are 2.6, 3.1, and 3 respectively, and they've been trending higher since late last year. So it tells you that inflation's not going away. Anyway,
I'm the housing guy, so I have to advocate for lower rates.
But the one point that jumped out from my side, it sort of talk obviously, was the food prices.
Oh yeah,
sorry, that was bad.
That's the one that's really hurting everyone, especially lower.
What was the uptick on that?
Yeah, so I have an arrow going higher on my notes.
Well, so by the way, there's a really cool website called, you can literally just go, if you just Google StatsCan Food Price Data Hub, which is actually really cool. It splits out. So you have the normal StatsCan data shit and like whatever, CPI, all this stuff. But then there's a whole split out specifically for food, which probably the certain government officials almost certainly ignore. And you can see the index for food purchased from stores, which is an annoying way of saying groceries, basically, is, I lost the chart now. Has risen to 3.4%. So food purchased from stores, groceries, is 3.4%, well above the range.
Those damn Loblaws guys again.
And then food purchased from restaurants is 3.2%. What was crazy is there's certain things like meat is at like 9.4. So meat, there's different types of meat. Meat's at 4.7. Beef, frozen and fresh, is like 9.4.
Eatsy bugs.
I knew that was coming.
It's wild. There's some meat is a relatively important source of protein. And again, we're gonna get this in the comments, so I'm gonna cut you off at the pass here. Yes, we understand that these numbers probably grossly underrepresent what has happened over the last several years. But I challenge you, if you think
cricket prices are down.
Yeah, exactly. Cricket prices are down. But anyway, sorry, Keith, if you want, is that what you wanted to say?
Well, yeah, a couple of things. Do you know what the bug food and the birthday party Timbits have in common?
Go on.
Blah. I don't want to be touching on that stuff. None of it's good for you.
Oh man.
Wait, I do have something more intelligent to comment on this, because we're going to swim around a little bit. So we've just determined that with the Canadian data, it does give them cover to potentially cut if they want to. However, internally, we know prices are still very sticky. Mm-hmm. And if we want to, we don't need to go into big details, but we know inflation is also creeping up elsewhere around the world, especially with the Brits. Mm-hmm. That happened last week. And at the beginning of the year, remember we came up with a really cool name for central banks. That's going to be a race to zero. and they went from like 5 down to 3 or 2, depending on where they were. And then they put the brakes on. And we haven't talked about the race to zero now for a while because it didn't work anymore, really. I think now we've had this subtle shift where central banks are going to find cover to start cutting rates despite inflation staying sticky. But it's because the word about growth, which means, the housing market, the budget deficit, and all that stuff coming up. And, we have the 5 major central banks are coming up now in September, all of them. 2 on the same day. You have the Yanks and the Brits on the same day. The Canadians are coming out on the 2 days after Labor Day, and all of a sudden rate cuts are back on the menu. That's where we are. It's just this insane world at the moment.
So Richard's going to get angry at all of the central bankers who are now shifting to what I've talked about for years now is negative real interest rates. Now, what do I personally mean by negative real interest rates? It's the interest rate, or that short-term rate from the Bank of Canada, England, or whatever, below some rate of inflation, core or headline. I mean, you choose whatever you want. And to me, this is just like, this is why I hate is a strong word. This is why I detest central bankers, because by doing that, by running cover for these governments, it allows a bunch of negative outcomes. It allows them to run massive budget deficits when they shouldn't or can't, or, it is a transfer of wealth from the working class labor pool of people to capital. How is that? Because assets basically will be inflated. It's cheaper to borrow. Who owns things? Rich people do. It stokes inflation, which you're already seeing in the UK. Keith, what you didn't mention is the inflation actually surprised to the upside. So it beat expectations in the same week or 2 weeks or fortnight, if I'm British about it, that the Bank of England cut rates. And what's crazy is services was now up at 5%, and the Bank of England's own projections are for inflation to stay at 4%. And remember, people may not know this, but the Bank of England's target is 2%. And in Canada, I just fear it's going to be the same old shit all over again. And people I'm going to say it, people on the left are going to squawk and squeal about inequality. Well, if you want, one way to fight inequality is getting central bankers to move away from negative interest rates. And because of the way inflation hurts poor, because of the way assets are distributed, rich to poor, because of the benefits overwhelmingly go from poor to rich, from labor class to from labor class to the capital owner class. And there's my rant on negative real interest rates.
This is all to Keith's point, right? Which is you're reaching this end game, and there's too much sovereign debt in the world, and they have to basically derive some growth, some tax revenues. They need to keep those elevated. And one way to do that is to keep asset prices inflated.
I mean, it's sure they hate poor people.
Yeah. I've said this before in a lot of conversations, that we've had. I believe the visibility for where the world is going, it gets more clear by the week. And here's another example of this. We earlier talked about the housing market continues to, struggle, if you want to call it that. We've also talked about how deficits are out of control. And then you come down to central banks and monetary policy. And as their goal, we're going to combat inflation, and they even believe they can really control price inflation. I don't believe in that myself anyway. But now they're cutting rates at the exact same time when their job, like what they've been hired to do, is telling them, no, they should be raising rates if you think about it. This is part of the visibility that I've been talking about. This absolutely signals that they're trying to make it easier or give the economy maybe a chance to grow, but they're also now indirectly financing the treasury departments or the minister of finance, because they got to finance these budgets that are coming up. And all this continues to go in the exact same direction. And, this is a debt bubble. It's a super debt bubble. And, we're at the end of an 80+ year cycle from after World War II with Bretton Woods, at the end of a 45-year cycle, rates peaking in 1982. And people laugh, say, "Oh, you can never say it's different this time." It's not different this time. It's just the turn of this big cycle, and not a lot of folks are ready for it. So, and again, the only way out of a debt crisis, there's only one thing to do, but no one wants to do it. What is it,
I
Rich?
guess.
Yeah,
Stop
guess.
borrowing money.
Well, it's something else as well. You got to write. There's losses that have to come in the bond
Okay,
market, and we continue to go down that path. Unless maybe they land on Mars and they get a bucket of sand and it becomes the greatest energy source in the world. Who knows? But we are headed slam dunk into this, credit crisis, which is a liquidity crisis, for most folks.
So there's it's funny, right? Because I think everybody always talks about, like, in Canada anyways, they talk about the mortgage renewal wall, but they don't sort of talk about the sovereign debt renewal wall, right? I mean, I think this is effectively, yeah, Keith, to your point. I mean, these central banks are effectively financing the Treasury Department, whether that be in the United States or Canada or Europe. But we did get some updates on the Canada mortgage renewal wall, which we can chat about. But Keith, I also wanted to chat about a continuation of that, the sovereign debt markets, and some advice from Vanguard as well moving forward, which I think impacts your line of business. But Rich, you had sent me this BOC. They did an update on the mortgage renewal wall.
Yep.
So 60% of all outstanding mortgages in Canada are expected to renew in 2025 and 2026. About 60% of mortgage holders renewing are expected to see a payment increase. Most of these borrowers hold a 5-year fixed rate mortgage. So if you look at compared to the December 2024 payments, the average monthly mortgage payment could be 10% higher for those renewing in 25 and 6% higher for those in 26. But where it gets really interesting is, like, the biggest uptick is going to be people that had those 5-year fixed rate mortgages that are coming up for renewal. They'll see an average payment increase between 15 to 20%. For those that are renewing in 25 and 26, they'll see a 15 to 20% increase. While those with variable rates and variable payments will actually see a payment decline,
Which makes sense.
5 to 7%, because those people have already.
So the folks on the fixed rate, then, it's not uncommon to have a $2,000, $3,000 mortgage payment, for example.
Yeah.
So Loonie Hour math, did you say 15, 30%?
They'd see about a 15 to 20%. So if you go 3,000 and times,
tell them, Rich,
450.
Yeah, there we go. Smart man.
Let's call it $500.
$500.
So now,
you see the steam coming out of my ears while I figured that out.
Actually, I heard the grind going. But it's not a laughy moment, though, for a lot of families. So I think a lot of people then in this group, they're going to have to come up with an extra $500. And to be real about it, you don't come up with an extra $500. You're taking $500 from other spending.
True. There's been some wage growth in there, though.
There has been wage growth.
Air Canada's all over the wage growth these days.
But wait a second. Wait a second. There's one thing I think people often we need to connect those two dots. We talk about, the Central Bank of Canada we're not going to do a Twinkie bet today, but almost certainly will cut, even though inflation is sticky and rising.
Whoa,
which affects the short end of the yield curve. The long end of the yield curve, Keith, is not playing ball at all. And to square that circle, or to circle the circle, is it relates to people's mortgage rates, because the long end of the yield curve hasn't gone down at all in England, despite them cutting. In fact, it jumped on the news.
British accent, Rich.
It jumped on the news, governor. Anyways, and so what we're going to see is actually we've got the 5-year bond yield is at 3%. It hasn't gone down at all since the Bank of Canada started cutting. And so I think if the Bank of Canada does sort of do this quote unquote policy mistake, according to me anyway, I actually don't see there going to be any reprieve on the long end of the curve, or that mortgage renewal range, let's say. And in fact, you could make the case that actually the opposite might happen, which is people are going to realize that it was a mistake. Inflation's not going to be under control. You're not going to get growth. So all of a sudden there's going to be questions about credit quality, and not that the Canadian government won't pay you back. It's just that you won't get paid back in real terms, which will push up the term premium. And then Keith, one more thing just before I shut up, which is that there's $550 billion up for renewals in the next 2 years.
That's just in Canada, right?
Just in Canada.
Yeah.
So tack on another 92 billion that Mark Carney's going to issue. There's going to be huge, and then all the foreign investors that are leaving, and so you're going to have all this issuance with no one, not no one, but you know what I mean. I'm being using a little bit of rhetoric there, with fewer people to purchase it and absorb that issuance, which is going to push the yield curve, steepen the yield curve.
So that could give us, like Loonie Hour math, maybe an additional anywhere from 7 to 12 billion a year in interest expense.
Yeah,
from Ottawa, and we're currently at what, 55? I think 54.
Yeah.
So Keith, this kind of brings to an interesting point. There was a article circulating this week saying, quote, Vanguard says buy more bonds than stocks over the next decade. Top Wall Street banks are already on board. Effectively, Vanguard suggests forget the 60-40 portfolio. Vanguard suggests a 70% bond portfolio and a 30% stock portfolio for the next decade. So I'm kind of curious your thoughts, because that's counterintuitive to what we've been discussing, which, listen, hey, there's a bubble in the sovereign debt market, but yet Vanguard and the big banks are suggesting you actually should own more of that, not less of it.
Yeah, it's kind of like, say you're in the woods walking, and obviously you come across a rattlesnake, and you start backing up slowly, gradually, and you back right into Bigfoot, and he rips your head off for a bite. I hope that was a good analogy.
What the hell is going on right
terrible. Now, what does it
Well,
mean?
you run. Okay, my point with that, I thought it was great. It sounded very clever. So here's how these big
You're not
shops.
supposed to be in the woods. Remember, that's a fine.
Yeah, that's right.
Yeah, that's yeah. Okay. Remember, we agreed not to go there. But here's how these big shops come up with that kind of a decision. You always start with the market that has the most volatility, which is the equity market. Because, in any given year, you can be up 50% or down 50% with equities. Vanguard, they're using their valuation metrics, and they're just saying, you know what? We think equities are incredibly expensive right now. And at this level, the next 10-year risk-adjusted return is this number. And that's not acceptable. So therefore, we should not have a lot of money in equity markets. So by default, because they only live in a two-horse race, if that makes sense. If you don't have money in equities, by default, you're in the bond market. That's what they're saying. I think the irony with that, of course, I think the bond market, and this is just a view, so don't take this as investment advice or anything. I think the upside is 4% and the downside is 40%. I think that kind of a suggested mix, I think it's going to ruin retirements. It's going to ruin the big boat you want to buy and everything. And I'm sort of shocked to see it. Because another thing with this, you have to look at the evolution or the growth of bond funds over the last 15 years. And so you go back to 2010, and leading into 2010, most bond funds, and you just bought, government bonds, you clipped a coupon and you were fine. You made your 3%, 4%, 6%, whatever it was, zero risk. It was awesome. When rates hit zero in 2010, there wasn't enough yield being generated in bond funds just to pay the management fee. They couldn't do it. So they had to lower management fees and stuff. But then, because central banks, they suppressed the global yield curve for the next 10 years or a decade, one thing of it that way, bond managers had to increasingly take on more and more risk to generate an acceptable return. So they started buying, more corporate debt, more junk bonds, high yield, maybe some preferred shares get thrown in as a hybrid security, emerging market debt, private credit. So my view with this stuff is that the bond funds today, it's become a Frankenstein of what it used to be. They jolted this thing. It's now up.
No, you mean
Frankenstein's
No, you mean Frankenstein's monster.
Who's Frankenstein's monster?
Dr. Frankenstein is the scientist who creates Frankenstein's monster. You mean the bonds are Frankenstein's monster.
Oh, Rich, you're ruining a good story. Everyone knows the guy that was walked
You ruined it.
around, like that with.
People are gonna get confused.
No, they're not. They got to walk around like George Foreman, and things. But my point is that the bond market today is completely different than the bond market that these big shops are using to make like an overall, holistic view. And I'm hope, we're wrong with this, but hope's not a good strategy. The numbers do not add up where this is headed. They really don't. So when we shared that headline story that came out this week with the 30-70 split, like my jaw dropped, like that. It was
So,
a big
Keith,
one. What did you guys think about it? Like, what did you guys think about it?
I mean, you go first, I would say.
My thought was that Vanguard has lots of bonds to offload. Sorry, I'm back. I worked for hedge fund for a long time, and whenever we'd read a Goldman Sachs strategy piece or whatever, they're all JP Morgan, Goldman Sachs. They're all, in our view, they're all sort of the same. We would get that on a desk. They want to. Consumer staples, they're the next big thing, and then everybody on the desk would look at each other sideways and go, oh crap, they're trying to get rid of exposure that they have. That was honestly, Steve, that was my thought.
Well, maybe a bunch of crackpots would think if governments have all this new debt to issue, they need to sell it somewhere so that maybe the big shops will buy it. But seriously, that's a pretty dramatic suggestion that's coming out. Of course, everyone's a little bit different with what they're trying to achieve, but the bond market does not look like an awesome place, guys. It looks, and this, the concern with that is it's always been sold as this low risk conservative strategy, and still to this day. But yet, if you understand interest rates and duration and credit spreads, and global risk is come together, and it's not set up to be a nice experience. Could be okay, but boy, oh boy, Steve.
And Keith,
Vanguard's doing all the marketing for Ice Cap these days.
Keith? What about inflation? Right? If 3 is the new 2, or I can't wait
the bricks. I think 5 is the new 2, right?
Right, of course.
And you're clipping 4%.
Right. That's literally what it is. The bond. That's like, that's almost exactly to the number. The UK bond yield is 10-year UK bond yield is 4.67, and inflation is 4.16.
I mean, so today, it was another great conversation. We danced around. We concluded that a lot of these trends continue to go in a direction that hasn't changed the direction.
Yeah.
Next week we have a big Twinkie bet coming up, or maybe an almond croissant bet, maybe something like that.
Keith, it's going to be interesting. I think just a flurry of central bank meetings in September. We'll see what the race to zero looks like and how it shapes up. Whether 3 really is the new 2, we'll get confirmation probably of that in September. And I think we had a great conversation this week. National house prices, down 18.5%. The flood of rental supply coming to the market, inflation in Canada, and the pressure that's putting on food prices and the central banks, and where we kind of go from here with investment portfolios in the sovereign debt market. So as always, hopefully our listeners got some value and entertainment out of that. All we ask is that you share this episode with at least one friend or family member, and we'll see you next week.